Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Nevruzi and Joann Spadigam. A super busy week this week, but perhaps the Fed was one of the main events that we were looking forward to when we discussed last week. So let's start there. Jan, what were your key takeaways from yesterday's Fed meeting?
So let's just break down the meeting on decision, the press statement, and the Q&A. The decision and the press statement released at 2:00 were a little bit, I would say, a little bit more hawkish compared to expectations. The rates were left unchanged at 5.25% to 5.5%, so that was widely expected. But I guess that what the statement didn't do is it didn't fuel this kind of expectations that the Fed might go even faster, right? So the tightening bias was definitely removed, and it was switched into a more neutral language. So previously, the committee would have considered any further tightening. That language is gone, and now has been converted into something along the lines of in considering any adjustments to the interest rates, so implying neutrality. They also added a sentence saying that in considering when the committee, or at least the committee, does not expect to start reducing interest rates until they have gained greater confidence that inflation is moving sustainably to their 2% inflation target. Perhaps there was a little bit of a desire to push back against against market pricing. At least that was the kind of the initial takeaway from the statement at 2 p.m. However, the Q&A itself was at the press conference. The Q&A itself was a bit of a whirlwind. It rocked markets from in both directions, because when we started off from the get-go, there was a question of, all right, well, what is the criteria that you want to see? What are the criteria that you're looking for before you start actually adjusting rates lower? And I think Powell made something very kind of like, he made an interesting clarification that they're not looking for data to get better from here. They're looking more of this good data going forward. So we shouldn't be looking for data to improve even further for the Fed to start cutting rates. Rather, get a couple more of the confirmations, such as the ones that we already had. But as we get closer towards the end, however, a question was asked, which was surprising that it took almost half hour for that question to be asked, of whether the Fed could consider cutting interest rates in March. And Powell almost shot that down. He didn't fully close that door, but he certainly narrowed it substantially by saying that's not his base case. He doesn't think that by the time we get to the March meeting, the data will have changed in a way to justify a cut. So that's not his opinion. Of course, it wasn't like a open and shut type of case. He said that that's not his base case, but of course, there's a room for data to decelerate substantially, such as the non-farm payrolls that will come out tomorrow. Of course, listeners will have the advantage of knowing the information. I don't at this time, but when they come out, and if they're super weak, I think March is definitely in play. That's not our base case. We still expect May as the first cut, but I think about a third to 25% chance for March doesn't sound outrageous to me. And finally, on quantitative tightening, or when they would stop quantitative tightening, that question was also asked. And I want to say, so far what we've heard is consistent with our timeline. We expected them to have a brief kind of like mention of QT at this meeting. Powell said they did, and they're planning on having further discussions at the next meeting. I imagine that means that they will lay out kind of like the technical indicators that they're watching that we've discussed before. They're going to point out a couple of thresholds maybe that they want to keep an eye on, stuff like that. And just for reference, we expect in May kind of hint at a taper to come, and in June for them to actually announce a slowdown in the balance sheet normalization process. Whether that's going to be actually bringing QT to zero on a monthly basis, or whether that's going to be just decelerating the pace, is yet to be determined. We think they will actually halt the program, but it's not like we could also see that kind of going to like a half pace or something like that. But certainly we think by mid this year, we're going to see a change in the parameters of the program.
You touched on it a little bit when you talked about market pricing of a potential cut in March, but how did this week's meeting and the press conference and the subsequent move in markets kind of change your view, I guess, on rates, or well, near term or further up the curve?
What we differ mainly from the market is in the pace of cuts. We not only expect them to start in May, which is not that different from market, but we expect the Fed to reach its kind of end goal much faster than where the markets see. So we don't disagree with what is priced in right now in the curve as far as the ultimate end point. The current interest rate markets imply about 3 and 3/8. We see between 3 and 3 1/4. So it's close enough to not have high conviction that it must go another 10 basis points, 20 basis points lower. What we think will be different is that the Fed will get to the end goal much faster. So that would imply that stuff within 1 year, 1 year period looks attractive from that perspective. And we think once kind of like unemployment starts showing its rearing its head a little bit more, the Fed will be actually much swifter and kind of normalize rates. That doesn't mean that they go to zero, but 3% is the accurate number. What I think is an interesting risk factor is, well, what if the Fed applies a kind of like a 2018 style insurance cuts type of approach to lowering rates? In fact, what if unemployment stays pretty low and inflation comes down to target, and they decide to cut rates, but only by like 120 basis points? And at that point, I think what you would see is the front end perhaps doing pretty well because those cuts will come fast, but then everything else kind of steepening and selling off because the market have to adjust to the idea that the terminal rate's not going to be 3 and 3/8, rather than something like 4%, so 75, 80 basis points higher. So that would be an interesting dynamic to see, and we have to see how that over the next couple of weeks can evolve. But rates wise, we still think there's the 1 year stuff is attractive. We think further out the curve, so kind of like 10s and 30s are not what we want to have our longs on. In fact, don't really have too much, like I pointed out last week, too much sympathy with 10s hovering around 4%.
I guess away from the Fed, the other key event in the calendar this week for the US was the refunding announcement. What's your take on all of that?
For one, we got another round of coupon increases, and that was consistent with what we were looking for going to the announcement. It was similar. The sizes of the increases were the same exact ones as November. That was also what we expected. It's applicable with Treasury's kind of regular and predictable approach to funding itself, and also that type of debt, incremental increase in the debt issuance did fit. The financing estimates that we got from them also fits with, when we model out financing needs on a daily basis. We can use that type of supply to plug in the kind of funding gap from our side as well. So it was pretty consistent with the messaging. That's one. Number two is that the forward guidance in the policy statement indicates that this will be the final set of increases for now. We also thought that would be the case, and they kind of alluded at that at November refunding as well. So next quarter, we're just not going to see another set of increases. And if there is a jump in funding needs, those would come through more bill issuance, and vice versa. If their funding needs are lower than what they expect, it would also come from a drop in bills. They're kind of the shock absorber of Treasury. And finally, the issue of buybacks. As a reminder, Treasury will implement a program of buying back debt for two purposes: liquidity management. So they will buy off-the-run securities, and with the exclusion of certain securities, treasuries that are not the most recently issued ones, to provide kind of liquidity support. And they will also they'll have another buyback program called the cash management program to smooth out the maturity curve. That's similar to some European sovereigns. They also tend to do that, right? Like you would just buy, let's say, May, August, November. Like these refunding months tend to have larger amounts of maturing bonds and notes. So what they can instead do is, okay, we have a tax season in April. You have a lot of tax revenues coming in. Instead of playing around with the size and bill auctions, you can just take that money and buy back some of the debt, lower the volatility in the monthly debt cash flows. So that announcement was delayed by another quarter, the buyback announcement, but we're going to get the full details on the timing on May 1st with the next refunding. Presumably, they will lay out a schedule for buybacks, just like just like quantitative easing. When they're on a monthly basis, they would publish like the what they're planning on buying on each week, and the buckets involved. So we're getting details on that in 3 months, but I guess markets, maybe that was the reason. Maybe there are some other reasons going on at the same time with the kind of the banking community. But I think markets expected a little bit more from Treasury, and kind of swap spreads underperformed. And when I say that, Treasuries underperformed against swaps, so maybe expectations of buybacks starting faster, maybe even lower funding estimates. Maybe, like I said, there's like a risk-off move happening almost simultaneously, so hard to disentangle. But that's it from the U.S. for this week, and I'm a little bit stuffy, I'm sure, here, if listeners can hear my voice change a little bit. But I'll shift to the UK now, and give myself a little bit of a break here as I pass the baton to you. And because we also had the BOE, where they finally, I guess, broke their silence and updated their guidance on, on kind of, and I guess they updated guidance on a lot of things, but there was like an interesting split in the vote there. If you can give us your main takeaways.
Yeah, sure. I'm sorry, I didn't realize you were so ill. Otherwise, I wouldn't have made you go first and ramble on about the Fed for a while. But hopefully, you won't have to talk too much more. Yeah. So, listeners who listened to the pod last week will know that we were at the hawkish end of expectations for the Bank of England today. We expected a hawkish vote, so still some votes for hikes, which materialized in the end. We expected some hawkish revisions to the forecasts. What we didn't expect, which was what was delivered, although we said there was risks of this, was a dovish shift in the bias in the forward guidance. So they previously had this language around, very similarly to what you were just talking about with the Fed, Jan. They previously had this language that was clearly biased towards further hikes. They said, if we see evidence of more persistent inflationary pressures, then we will need to deliver further tightening. And they removed that and just have now this more balanced statement about, being prepared to do what is needed to return inflation back to target. And the forecast revision themselves, although in the near term they still see inflation above the 2% target, at the very end of the projection horizon, they do have, or the MPC does have, inflation coming down just below 2%. So it was those two things that I think the market kind of took its dovish cue from. But there were a couple of things to me that I think I would just highlight, which is why I don't think it was as dovish as perhaps some of the commentary out there might have you believe, or even what looking at the market reaction might have you believe. First of all, although the forecast did show inflation coming down below 2% at the end of the projection horizon, so at the 3-year point, and they have this kind of sharp dip down in the very near term, so it touches the 2% target in the near term before rebounding. Governor Bailey, many times in the press conference highlighted the fact that actually inflation remains well above the 2% target for the majority of the forecast horizon. And of course, those forecasts are conditioned on market expectations for bank rate. And at the time that the MPC took the cut for their forecast, that was, they're kind of implying around 100 basis points of easing would give you inflation just below the target at the 3-year horizon, but for much of the period between now and then will average above the target. So, my take of that is that implicitly the MPC is telling you that at this point they think 100 basis points is really the kind of upper bound of the scope of easing that they will be delivering this year. Secondly, although the bias is now no longer skewed towards higher rates, they introduced this more balanced statement around just doing what is needed to bring inflation back to target. I think there are 2 points. Firstly, very similarly to what you said on with Chair Powell at the Fed, Jan, Governor Bailey was very clear not to kind of talk about the fact that cuts would be the next move. I think he was asked many times, you've changed the bias in the statement. When does that mean that you are cutting? And instead, he shifted the focus of the conversation around, yes, we've removed the upward bias, but now the discussion is very much around how long rates need to remain at this level. We're still in this Table Mountain type narrative for the BOE, and they're not yet at the point at which they're discussing cuts, which I think is very evident in the vote. There's still 2 members voting for hikes, and even if Dingra voted for a cut, I think markets can largely kind of ignore or don't place so much weight on the fact that she continues to be a dovish outlier. That's not all that surprising given her voting track record. For me, the tone at the press conference was very much about being data dependent, but in the same way that we've heard from the ECB and the Fed recently, it's very much about seeing more evidence in the data that inflation is kind of converging sustainably to that 2% target, which in my mind, and just kind of steal one of Lagarde's phrases, but flip it on its head a little bit, does make them date dependent as much as it makes them data dependent, because if they're waiting for, the wage inflation data from January and from April, they won't have that before the May meeting. And so to be able to be confident and see evidence in the data that inflation is converging back to target, they are as much date dependent as they are data dependent. So I think there was a clear pushback on timing of early rate cuts as well through the language in the press conference. And just finally, when thinking about when the balance on the council might switch in favor of rate cuts rather than currently to keep rates on hold, I think it was worth taking note of the comments from both Broadbent and Ramson in the press conference, both of which I think had quite hawkish tones around them. Broadbent was quite clear that he felt like the argument that they needed to cut rates because monetary policy was getting more restrictive as headline inflation came off was just wrong, essentially. And he talked about the fact that the easing currently being priced into the market at the 2-year point of the curve reinforces the need for the Bank of England to keep rates on hold now. Whereas Ramson referenced a couple of times the kind of persistently high service price inflation, the fact that that was still north of 6% and not really trending down. But also he quite clearly highlighted the difference between service price inflation in the UK and what we're seeing in the Euro area and the US, where it's, a good 2 percentage points below the levels here, which, implicitly, again, he's saying just because the Fed are cutting or the ECB might be cutting doesn't mean that we have to as well. And there's not all that much difference in terms of what the market is pricing and of their reaction functions. And I think Ramsden was giving a bit of a green light there to actually, there could be quite different reaction functions. So I think that if you looked at the market reaction into and out of the meeting, you would think it was much more dovish than it actually was in my view.
And how does that change your market views, if at all?
Yeah, so, we went into this meeting and we felt like there was a really high bar for the Bank of England to outdove the market, which, as I've said, I don't think they at all endorse this kind of market pricing. Yet we have seen, well, the knee-jerk reaction was maybe a little bit hawkish, but that was faded pretty quickly. And then the decision maker panel survey, which showed inflation expectations falling in the 1 year ahead part of the survey, then fueled a kind of another rally in UK rates. So for me, my market views are unchanged. I'm kind of happy to take the other side of the market here that thinks that this was a dovish meeting. I don't think it was that dovish at all. I think they were endorsing around about 100 basis points of cuts, as I've said, as the kind of upper bound for cuts this year. And I think they were pushing back quite heavily on market pricing of early cuts. If they're not even discussing it now, really, and they need to see the early kind of Q1 wage data, that cuts discussion won't come for a while. So I'm still happy with the same kind of market views that we had previously, fading that early cut pricing. I guess that's the difference between our US view and our UK view, is that actually in the UK, the scope of pricing being, the scope of easing being priced into markets this year isn't that different to our central scenario. It's more about the timing of that easing. And so, 15 basis points of cuts being priced in by the next couple of meetings, I think just feels a little bit too aggressive. And the other thing that I think is somewhat surprising is the outperformance of gilts on a cross-market basis. I think that there's good reason to think that the BOE could be the last to cut rates. I think that they could be on hold for much longer than the ECB and the Fed. I think they have a stickier and perhaps more troubling inflation outlook. Like I mentioned, service price inflation is still much higher and persistently at those higher levels. We're probably talking about a little bit more fiscal easing, which brings upside risks on the supply side. We've got different but probably bigger structural shifts on the demand side as well. And all of those things, I think, combine ultimately to drive kind of cross-market underperformance of gilts. And perhaps there's most value there in being, seeing more underperformance versus euro area and versus bunds versus treasuries. But I think I would again fade today's kind of cross-market outperformance. I don't think that fits with the message that we've heard from the BOE or the fundamental backdrop in the UK. But of course, it wasn't just about the Fed or the BOE this week. Like I said at the beginning, it was a very busy week. We also had euro area inflation. That was kind of key data print on the euro area side. Joann, what did we learn from that this week, do you think?
So the euro area inflation print for this week came in broadly in line with expectations at around 2.7% year on year. We had 2.6% in that. The uptick was mainly driven by some small idiosyncratic effects in Germany. But I think overall, the inflation print really doesn't change very much of the message, which is that inflation is coming down in the euro area and perhaps sooner than or sooner than the ECB's projections suggest. Both us and markets have inflation at under 2.5% for around February and March. And of course, we think the ECB's projection should again be revised downwards in order to be in line with this view and in line with the figures that we've had of late. I guess like the move lower from 2.7% to 2% is perhaps a bit more difficult than that kind of large decrease we saw driven by base effects through last year. And I think we were talking about the dispersion of estimates around the European CPI print just for this week. So there's clearly a bit more of a spread in terms of estimations for the inflation print moving down towards the 2% level. But I think if we are correct and that does happen, it really does open the door to the ECB cutting rates later on this year as well. We do think and maintain our base case that the ECB does cut by 50 basis points in June. Obviously, the ECB is a consensus-seeking central bank, so there'll be lots of discussions around and views around the table, really, about when the rate cut cycle should begin and when that does actually come into play. But I do think that with the more cautious approach that some of the hawks will take, and I suppose the comfort in knowing that when rates cuts do come in, that you can just cut a bit quicker. It could be that actually, even though April is live, that the cut only does come in June. But yeah, I think in terms of this week, not much change to our view overall.
And of course, it wasn't just about, or this week wasn't just busy because of everything that was on the calendar. There were also events that weren't on the calendar, like a couple of syndications, which came as a bit of a surprise at the beginning of the week. We had Germany and Italy announce syndications that we weren't expecting. And I think that's just fitting with the theme of 2024 so far, that, we've had huge front loading of supply, yet it seems to be relatively well digested. We're now at the end of, we're at the 1st of February as we record this. January has passed, but a lot of fears around just how heavy January supply could be and how much that might weigh on the market seem to have been dispelled a little bit. What's your takeaway on the supply front, I suppose, in terms of how well it's been absorbed, but also what you're thinking about for the next couple of months?
So, I mean, it was fairly interesting that we got these two syndicated deals at the start of this week. That wasn't really what we were expecting as well. So I do think there's this idea of both on the issuance side having lots of demand for the supply that's coming, but also on the issuer side, this idea that they really want to capitalize on how well supply has been going and how well digested it is, and on this really, I suppose, enthusiastic demand for all of this paper. So I think we could see a couple more syndications in the weeks to come. So Spain and Belgium are the ones that we are thinking about as the next potential syndications to come. But I do think it's been, like you said, very interesting how well the supply has been absorbed. I think in a week like this week, where of course we had quite a lot of supply, we saw a bit more, I suppose, stress in today's French auction, where they did do a bit less off the long end, given potentially a lack of demand there. But I do think that, I suppose, in weeks where supply is really heavy, you get a bit more of the supply indigestion. But overall, it does seem to be that investors are keen to kind of front run this central bank cutting cycle and to take in paper before that. So I would think that supply gets pretty well taken down in February as well. The one thing in February that I will say is that because we will likely see a lower amount of supply in February than January, as well as a marginally higher redemption profile as well, the overall amount of net supply for February should be lower than January as well, which should help supply to get digested a bit more easily for February as well. But I think the key theme to watch remains to be supply and digestion, given that QT is also on the cards.
Yeah, lots to watch out for. Okay, thank you both for joining me and taking time out, because I appreciate it. It's been a chaotic week. Thank you to our listeners for listening in. And just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.